I donate a piece of land up the Rattlesnake for to Habitat for Humanity to build. Great example. How much do I get to write off?
Fair market value.
I'm going to get an appraisal on the fair market value of it, and I'm going to get to write it off. But up to 50% of AGI. Now, there's a carry forward on it, right? So yeah, say that I make 70 grand a year and I'd inherited a piece of property that I decide to give to Habitat. Okay, that's great. It's going to obviously be more than 50% of my AGI, but I can carry that forward every year until I've eaten up the, 200,000 that it's worth. Okay. I think that's. What about if you let people use something of yours? So I let them take my RV, the church group take my RV. No? This question I get a lot, like my gal I think I've told you about before that's a really beautiful artist and weaver, and she gives a lot of people will come to her and say, will you give a piece for a silent auction? Right? Hospice is doing a silent auction, will you give us one of your beautiful weavings? So she gives it to him. Then at the end of the year, she says to me, I could have sold that weaving for $800. I get a charitable contribution for that, right? Does she?
Would it be the amount that they sold it for?
This is a really tough one to explain to clients. No, she gets no write-off for it. So think about that. She takes yarn, she works it, and turns yarn that's valued at, $40 into something she can sell downtown at the Missoula Artist Co-op for $800. And I have to tell her you get no write-off.
What if they were to give her like a letter stating that, she gave them this?
Well, that's not a problem. We can have proof that she gave them the weaving. The issue is that it is completely subjective. She can say, well, a weaving like that last year I sold for $800, but who knows if it's even, worth $800 this year, or what happens to it. The only thing she really got to write off is her yarn went through cost of goods sold. The value of her labor to convert that yarn to a finished piece of art. If I've done this a couple times, given free tax returns to be auctioned, right? So I did that at Sustainable Business Council a couple of years ago. They put it up for auction, and somebody bought it for $400. So then they call me, and they're like, you need to do my tax return for free. I have the certificate that you donated. So do I get to write anything off? No, because it's just the value of my time. And I could say my time's worth $1,000 an hour.
What the average tax prep rate
Nope.
is.
It's too subjective. The IRS just won't go there. Any labor you donate or value of things that you own, your boat, your RV, your ski cabin, none of that's deductible. Okay.
So it has to have a fair market value.
It has to have a fair market value, and it can't be the product of your labor.
Right.
So how does that work then if you, let's say that I prepared taxes out of my home and that's what my business was.
Yep.
And I donated a couple of tax returns like what you did. How does that work then? Because I'm
You just don't get a write-off. You don't get a write-off because it's your labor. Okay. What else do we need to talk? Oh, and then you get a mileage rate, right, for charity. How much was that? 14 cents a mile for driving. Okay. Casualty and theft. So we're just going down our Schedule A. I think we're about, what page was that on? Oh, can you flip the lights, Jess? Schedule A, page 5-33? No, 53. So now we're on the section called Casualty and Theft Losses. It's just a little tiny one item, and it basically says, line 20 on page 553, Casualty and Theft Losses, attached form 4684. Okay, let's just talk this through because this is a pretty complicated area and it's a little bit above our scope, so I'm going to try and just kind of tell you what I think you need to know. So you do get a deduction for casualty and theft. Casualty is something that happens that's a sudden, unexpected, or unusual event. And these are the three words up here. So there's been tax cases, for example, where termites or carpenter ants or erosion slowly degraded my commercial building. No casualty write-off because it's not sudden. Sudden's like a tsunami, a tornado, a hurricane, a flood, stampeding buffalo.
With the wildfires that destroyed the house.
Wildfires, absolutely.
And then like with the sinkholes that keep appearing like in Florida or whatever.
Well, we know what the sinkholes are caused by. Rising sea levels, attributable to, I wonder what. Okay, so if it's a theft, you need to prove it. So you've got to show a police report, an affidavit, or something. You can't just be like, I remember one year this guy was like, my golf clubs got stolen out of the back of my car. Can I write them off? And I'm like, no, you can't write them off. You didn't file a police report. They were old clubs. So that's not going to happen.
But didn't your insurance or home insurance or renters cover those? So why would you write them off if you're getting it?
So it's only for uninsured losses.
Okay.
So a lot of times, particularly it's kind of a Montanan thing, people don't like taxes and insurance here. So when you own things free and clear, a lot of people have a tendency then to take them off the insurance rolls. And so then if something happens to it, that's essentially on you, right? Or you're underinsured. So I own my little, cabin up Rock Creek, and it's probably worth 150 grand, but I've only got it insured for the old structure that was, the cabin from the 20s for 30 grand. And it floods, gets washed away, I'm woefully underinsured, right?
So, in that case, what, nothing? Or
No, you get to write off the difference between the decrease in the fair market value before and after the flood, which it was worth 150 and now it's worth nothing. Right? So technically I should be able to write off 150. I get a $30,000 insurance reimbursement check, so now I'm down to 120. And then the last thing is, you guys, it's only in excess of 10% of AGI.
casually?
Yeah. So honestly, I've seen very few of these. 2 rules. Just what Perry was asking. Rule A is based on the decrease of fair market value, but it can't exceed the adjusted basis of the property. The adjusted basis of the property is cost minus AD. And this is used for partial or complete destruction of personal property or partial destruction of business or investment property. Or Rule B, you get a deduction for the adjusted basis, and this is if it's completely destroyed and it's business property. So really, again, this gets complicated really quick, but just what I want you to know is there's different rules if it's something you personally own, like my cabin up Rock Creek, or it's business or investment property, like my commercial building in Ovando that I rent out to outfitters. So there's different rules. The second thing is there's different rules if it's complete destruction or it's partial destruction. And like I said, this gets complicated pretty quick, but really what you need to know in my mind is right down here. The math is as follows. My loss equals whatever I lost in excess of my insurance proceeds. So you've always got to reduce your loss by whatever you got from insurance. Then you subtract a $100 floor, negligible. Then you subtract 10% of AGI. So that's really the calculation. And when you do a 4684, you'll do that for the second manual tax return. They have a hangar or a shed somewhere in Arizona, and there's a windstorm, and it's uninsured, and they lose their hangar, their airplane hangar. And so you're going to have a 4684, which is the name of the form that you do to file a casualty and theft loss. Okay, next section, job expenses and certain miscellaneous deductions. These are, and let's just kind of go through them. There's two types. There's rows 21 through 27, and then there's row 28. 21 through 27, if you look at line 26, are only those in excess of 2% of AGI. Line 28 are all the other miscellaneous itemized deductions that you don't have to subtract 2% of AGI from. I'm starting on line 28 with this screen, and there's only 5 things that you don't have to, they're called miscellaneous, that you don't have to subtract 2% of AGI. Impairment-related work expenses. So I'm severely handicapped and I've got a job coach that comes with me. I've got a service dog that's quite expensive. Those are impairment and work-related expenses. I get to write those off and I don't have to subtract 2% of AGI. Estate taxes that accrue to me, this is a little beyond our scope. Amortizable bond premiums pre-1986, like you ever see those. The only one I really ever see is this 4th one, gambling losses to the extent of gambling winnings. Can somebody refresh my mind what happens if I win $5,000 this year and then I lose 8? What happens to the 5 and what happens to the 8?
The 5 washes out the 5 and the winnings.
Do I have to declare the winnings?
Yeah. But you
Yep.
declare your losses.
I declare the winnings and they go where on my tax return?
So the 1099. Oh,
Yeah, line 21, my other income. Then I lose 8. Where does that go?
I only get 5 of it.
I only get 5 of it, and it goes on that line 28 on my Schedule A. If that's my only itemized deduction, do I itemize or take standard if I'm single? Standard, because it's 6,200. So do I really get to write off my gambling losses? No. So it really doesn't net. So to answer, oh, it always nets is not correct. Because if you don't itemize, it doesn't net. Okay. Everyone get that?
Yeah.
I see those maybe every 5 or 7 years. You see a lot of these. The amount's limited to over 2% of AGI. Unreimbursed employee expenses. What are some, and you have to use a 2106 or a 2106 EZ, and we'll look at those in a second. What are some examples of unreimbursed employee expenses? So you have a job, you have an employer, you get a W-2, but you have to spend money to keep your job. Like what? Sorry? I'm probably not going to be paying workers' comp. My employer's going to be paying it. No, I'm the employee in this example. What kinds of things do I have to spend money on to keep my job?
You need new power tools.
You need tools to do your job, absolutely. I need specialized clothing to do my job. I'm an anesthesiologist or a nurse or a PT. I need scrubs.
Realtor dues?
Yeah, I'm a realtor and I've got to pay my brokerage fees and my annual dues to the Missoula Organization of Realtors. I think I told you guys I've got like $2,000 a year I have to do to keep my CPA, right? I've got to do all this education and relicensure. Those are all examples of unreimbursed employee expenses. But as you can see, they're phased out by 2% of AGI, so they've got to be pretty high, don't they? So 2% of AGI, say you make $40,000 a year, 2% is $800. So you only get the amount in excess of that. We'll take a look at this further. It also, the tools, the special clothing, the fees, the dues and subscriptions, the education. What if I have to drive my own car to do my job? I get mileage for it, right? Okay. Union dues are a write-off. Tax prep fees are a write-off. Safety deposit box is a write-off. Professional journals and subscriptions. Investment expenses and job hunting fees. And you can see that just goes right down line 21, 22, 23. Add those all up, subtract 2%, and that's your miscellaneous itemized deductions. They want to tell you a little bit more about investment expenses. That's only if it's for things that are directly related to taxable income. Like, I subscribe to the Motley Fool, which is like a little investment blog, right? And that's $50 a month. And I use that to make decisions to buy and sell stocks, okay? That's a write-off as an investment expense. The money that you pay your broker to actually buy the stocks and bonds do not go here. Those are part of the basis of the stocks. Tax prep fees go here, and job hunting expenses. If you're seeking a job in your current area, you can deduct those. But if you're going like from school to a job, you can't deduct them. Or if you're unemployed trying to find a job, you can't deduct them. But it would be like, oh, I'm a nurse here and I want to move to Wichita. So I go to Wichita and I look for work there and I do some interviewing at some hospitals there. Then I can write that off. But not if I just graduated from nursing school. Okay, so this is talking about, let's go back to the idea of I drive my own car. Many organizations, if you drive your own car, allow you to put in for mileage, right? So if I drive my own car for mileage and they reimburse me, is that going to show up on my W-2 or not? Okay, it depends, doesn't it? It's not on the amount, it's on whether or not the company has a what? A plan, an accountable plan. Do you remember this from payroll? An accountable plan is one that the company has written and put in the corporate bylaws that's compliant with the Internal Revenue Code. And an accountable plan basically says, if you put in for expenses to be reimbursed, you've got to show proof. It's got to be, authentic. It's got to be verifiable. There's all these buzzwords. And then I can reimburse you. Then it doesn't need to go on the W-2. But if I don't have an accountable plan and I reimburse you for stuff, it does show up on your W-2, which sucks for you because your itemized deduction's only in excess of 2% of AGI. So you don't get a whole, again, it doesn't all net, does it? And it's only if you itemize it all. So what I'm saying is, say that you drive 50 miles a week for work. And you put in, they don't have an accountable plan. I think you get 53 cents a mile. So you get $250 a week. Right? No, 25 bucks a week, sorry, for mileage. So $100 a month, $1,200 a year. That shows up on your W-2. And you pay tax on it. How does that feel to you? But shouldn't that be income?
You paid for your gas.
Yeah, you're just being reimbursed for wear and tear on your vehicle, your gas, your oil, your tires, all that, right? So really it doesn't feel very good that that's income. I want to turn around and write that off, right, on my line 21 on my Schedule A. Except for I don't own a house. So I'm probably not going to get to itemized deductions, am I? So I'm paying tax on that $1,200 even though it's really a reimbursement. Does everybody understand the issue here? Okay, and then this is sort of just a topic. I'm not 100% sure why it's in this chapter because it's not a Schedule A issue. But I guess they've got to put it somewhere. And it's this kind of huge area, got a sore throat, around education. And this is one of those things that Congress has revisited 1,000 times with tuition rising so fast, so much faster than the rate of inflation. It's so expensive. People, students are so far in debt. It's becoming so unaffordable for so many people. How do we help people from a tax standpoint make college affordable? So what's really come out of that is this huge mishmash of laws and options that are actually pretty confusing for the average person to understand. So hopefully I can kind of unpack this for you. So the first thing is, this is for people that start saving for education when their kids are young. It's called a Section 529 plan. They're called QTPs, but in practice, everyone refers to them as Section 529s. And basically what this does is you either can buy tuition credits at today's prices, or you can start to put money away in an account that you're going to use for your kid when they go to college. If you do this one, like I buy in-kind tuition credits at the University of Maine, that means that I know my kid's going to college at the University of Maine. How many people know that? I mean, I sure had no idea where my kids were going to end up at college. Still surprising to me how that all worked out. So that's only if like you're a Grizz, your folks were Grizz, you know your kids are going to be Grizz. Okay, then you can do that, and that would make sense. So what you're doing is locking in tuition at today's dollars for your kid. Or not maybe your kid, maybe your brother, your spouse, anybody that's a dependent. Or you can put money into an established account. And this is what I try and get most of my clients starting to do. If you've got kids, let's at least get a 529 set up and put in $25 a month for each of your kids. You don't get a tax write-off for it today, but then when you take it out, it's not taxed. But everything you earn on it while your kids are growing up is tax-free and goes straight towards tuition. So it's a really good vehicle also for grandparents. What I did with my kids, which they loved, when they were growing up, as I told our folks, we do not need more plastic toys from China in our house. Put money into their 529. And so for Christmas, they put $100 in the kids' 529. Okay?
We have a 529 for our kids, my sister does too,
Mm-hmm.
and everybody commits to 35 a month all year long.
So smart. So smart, Gretchen.
And so that's, and we do the same thing with birthdays.
Huge. That's so smart. If people kind of could reevaluate this consumptionism into the saving and philanthropy, we would have a whole different country.
And when you think about it, if we only do 35 a month, it's really not that hard on our book.
No, and it's not going to be, it's not like, oh gosh, you're going to be able to write a check and pay for your kids to go to college on that. But what you are going to be able to do, and what our account did, was it did stuff like took care of, maybe the dorm bill for a semester, or, bought the books each semester. Or, it was honestly, in the whole scope of things, wasn't that big of a player, but it was a piece, and every little piece helps.
We have like 10 aunts, uncles, and whatnot, and we all put in 35 to my nephews, and then we do our own kids separately, differently.
That's just such a cool family thing to do.
Yeah.
Super smart. Because when you get there, as you guys all know in college, it's not just writing out the tuition check. You've got to get the laptop, and you've got to get the books, and you've got to get, if you're in anything like welding or culinary, you've got the knives and the tools and blah, blah, blah. So you get your computer can come out of your 529. The one thing you don't ever want to do is go into your 529 and take it out for non-educational things. It's taxable plus a 10% penalty. So it's like rating your IRA before you're of age. But that's really, really smart. And it helped. It helped when our kids got to school. The thing about QTPs that are kind of interesting is the IRS doesn't give us an annual limit. So for most of us, that didn't really matter because, we weren't putting in that much. But if you have like grandparents that, all of a sudden decide they're trying to get rid of 10, 20 grand a year, there isn't a limit, okay? Now, here's the scoop, and this is what's really important. So so then you've got these credits. So the QTPs are how you fund saving for college. Then you get there, and what do you guys all take on your tax returns? You'd probably take the American Opportunity Credit, right? For the first 4 years. It's worth up to $2,500. I hope you're all taking that. Are y'all taking that?
I don't know. I know that, because I use a software program, I've always used a software program, so I don't know if it's.
Here's the problem with software programs is it would be like me doing my own blood work for my well check. Here's a software program, Lisa. Now plug in all these numbers and diagnose yourself. I mean, you don't know what you're looking for. So the software's like, plug in these numbers. I get more comments. Last year I got a gal who had plugged in numbers for a rental under, give us information about your house. So she put in all the information. Give us information about your rental. So she put in all the information. So it put it as if twice, right? Her Schedule A and her Schedule E. So she brings it to me and I'm like, I start looking at this. I'm like, all the mortgage, interest, property taxes are exactly the same on both. I'm like, what the heck's going on here? I had to amend her tax return. She had to come up with $3,000 to pay back the IRS and the state. So the point is, hopefully, one thing you'll at least walk out of this class with is the ability to do your own tax return at a level that makes sense and help people around you in your world do their tax returns. So my point is if you take money out of a 529, you can't use those same dollars towards your American Opportunity Credit or Lifetime Learning Credit. So you get American Opportunity for the first 4 years of college, full-time college, and then lifetime learning for the rest of your life. So I go to grad school, I go back and get a second bachelor's, whatever, you get your lifetime learning forever.
How much is that one?
That's worth up to 20% of the first 10 grand a year that you spend. So, but it's not refundable. This guy's refundable, the American Opportunity Credit. So it's like earned income credit, even if you're super low income and you don't make much money and you don't owe much tax, you still get it back in cash. That's why it's so valuable.
I thought it was $1,000.
1,000 of it's refundable. 1,500 of it is the deduction on your current taxable income. So it's split kind of into 2 credits.
So if you're, in my case, because I have the VA,
Somebody else pays for your school. You don't have any out-of-pocket expenses.
so then I can't do the American Opportunity Credit.
I would guess, I mean, I have no idea how VA works, but are they paying for your computer, your books, your fees, your everything?
Yes.
Yeah, I don't think,
Okay.
I was told, I was the only one use it.
Okay.
I
So
can,
if you use
yes.
something like that, it would got doctors.
They
Okay.
pay for.
Okay, so or if you get a scholarship, right? But then people will say, well, or grants, anything you don't have to pay back. But what if you borrow to go to school? Then do you get American Opportunity? Sure, because you're liable to pay that money back.
And there's another thing, like the military, I know like, you can $10,000. So there's an issue. You can only use, you can use one or the other, you can't use both. Choose anything between.
Right, well, I guess I would take the one that I didn't have to pay back. I mean, Okay, education savings accounts, nobody uses them, so I'm just going to fly through them. Higher education expense deduction. I don't know if you remember who we did this on. It was one of our early cases where you had to go in and launch the optimizer. Does this ring a bell? Right? So there's a couple different places that your tax return, where paying for higher ed might show up. I don't know that I've ever seen this one come through on the Launch the Optimizer. Almost anyone I've ever done, they get the American Opportunity or the Lifetime Learning Credit. But there's also a deduction for AGI on, where is that? Line, I don't see it. It's an above the line deduction. So I'm looking for it in lines 23 through 36. Higher ed, but I'm not seeing it on here, huh? Oh, I bet you it's on that line 34 that says reserved. So this is, and like I said, I really, for everybody I know, the American Opportunity Credit or the Lifetime Learning is more valuable than this. And then student loan interest, when we talked about interest, how much of that do you get again? Anybody remember? No. Let's see. I don't honestly remember. Let's go back to interest and see how much we get for student loan interest. Let's see.
Limited to 10,500.
Okay, here it is. Education loan interest. Yep, up to, yes, it does phase out. Up to $2,500 per year. It's a deduction for AGI. It's called student loan interest deduction, line 33. But it phases out when your AGI gets to 65,000 single or 130 married. I have a lot of clients that get this, and they get I can't remember exactly what kind of 1099 it is, or maybe it's a 1098 something, and it tells their student loan interest. And then you just plug it into the software, and it's going to show up here with a phase out if they get to be higher income.
The higher income you are, and you get a paycheck.
Yeah, and then it goes away altogether, at a certain amount. Okay, so the last thing that we need to look at then is phase outs. This was part of, we used to have these forever, and then they were taken away. The phase out was taken away under the Bush administration as tax law became more amenable to higher income people. Under the Obama administration, they were reintroduced, which means if you're pretty darn high income, you start to lose your itemized deductions and your exemptions. Pretty high deduction, pretty high income, and this really is pretty high income. 254 single, 279 head of household, 305 married filings joint. You can read the amounts. Then, after you've done your whole Schedule A and come to the numbers, you start to lose 3% of the excess of your AGI over these amounts.
So if you're high income and you don't get those deductions or whatever, and you're paying, so you're in the 33% tax bracket.
39.6 is the highest.
Right, but okay, so even if, so you're in the higher tax bracket, and you're having a ton taken out every 2 weeks or whatever you get paid, is there a way of avoiding having to still pay it at the end of the year?
Well, sure. I mean, if you've got a good tax preparer, if you came to me, Gretchen, and I took all your information for you and your husband and your kids and blah blah blah, and I did your tax return, you got $4,000 back, everybody would think we'd be happy, right? But what would I really try and tweak for you?
To make me even.
I would try and get you that extra $330 home on your paycheck every month.
Right.
And actually, what I would say to you, if you're living without that $330 a month, let's funnel that straight into your Roth, right?
Yeah.
So it's not a benefit to get back a lot of money at the end of the year. I know it
No.
sounds like it's a benefit,
Just to avoid.
but it's not. And if you're living without that money, I mean, my kids hate having me for their tax preparer. I'm like, dude, you lived without that $2,400 all year. I'm going to take it and put it in your IRA. And it's like, I want to go to Scottsdale. You're not going to drink away $2,400 on my dime, okay? I'm going to take it and put it in your IRA. So, and I'll tell that to any client. Now, similarly, if you're paying in $5,000 at the end of the year, what am I going to do? I'm going to adjust your W-4 and either just have that taken straight out of your paycheck, or I'm going to get you on quarterly estimated payments and have you pay in $1,250 a quarter. Most people, I adjust my W-4 so that all the taxes that I need to pay on my consulting and my writing and my tax practice come out of my paycheck, because I don't want to have to write a check every quarter. I would rather just have it come out of my paycheck and live on less.
So when you are higher income and you have your W-4 just regards that you have the absolute most amount of taxes each time.
But there's a line that says additional FIT withholding.
Right, no, I mean, I'm just, I
then you want to have additional FIT withholding. So if nothing changes between year 1 and year 2, so you're unemployed, your husband's W-2 is the same, you have the same amount of kids, basically roughly the same amount of itemized deductions, and last year you paid in $2,500, you're going to want to go to the W-4 and say take out an extra $200 a month, right?
I'm just being selfish.
Huh?
I said I'm just being selfish trying to figure something out while we're in class.
Well, no, that's fine. Those are all good. Those are good illustrations for everybody to learn from. Additionally, you also have to phase out your exemptions. They are reduced by 2% for every $2,500 or fraction thereof that your AGI exceeds the threshold amounts. So what the heck does that mean? So if say my AGI, and I'm single, is 3, oops, yeah, I didn't think that was going to work. I've got to get the numbers out because I don't know those off the top of my head. 254.2, okay, 254.2. So if my AGI is 300,000, and I've got 4 exemptions, what would you hope that I could take for exemptions?
The max, since your AGI is so high.
Yeah, I mean, what would it be if I didn't have a phase out? No, exemptions.
15,800,
Is that 3950 times 4? How much?
15,800.
3950 times 4, right? I get 3950 for each exemption. 4 people. But I'm not going to get that because I'm over the amount, right? I've already forgot the number. What was it? 254.5?
254.2.
254.2. So that's 45.8 over. And what they said is that you've got to take this amount and divide it by 2,500. And however many times that is, you've got to reduce it 2% times that. So, I know. This is tax law. It's so convoluted. It's like, really, this is our Congress people at work. Okay, 45.8 divided by 2,500 equals 18.32. So you always round up. So now that equals 19. Times 2%, so I'm going to lose 38% of my exemptions. The thing is, it does. You always end up ahead. Once you hit the highest marginalized tax rate, there's nowhere else to go. I feel like I have to explain this to people over and over. And so can somebody explain this to me? Because this is frustrating to me as a tax preparer that people get so ticked at the taxes. Oh, it doesn't even, I'm not making any more money. If you move from the 28 to the 33% bracket, what dollars are taxed at 33%? Only your new ones. Only your new ones. And you're still 67% better off than you were before the raise.
Right.
People, I don't mean to be, but I mean, people, I mean, I have so many like super anti-tax people and they're like, oh, it just doesn't pay. And I'm like, you know, I try and explain marginal tax rates to them and the fact that you're still 67% better off than you were before. And it's almost kind of like people don't really want to understand. So anyways, so I'm losing 38% of my exemptions. So I'm going to ask Jess or Joey to answer this because we've been having these conversations. So if I lose 38% of this, what can I just multiply the 15.8 by to see how much I get? Nope, that's how much phases out.
62%?
Yeah, I'm just going to take it times 62, and that's how many exemptions, that's how much my exemptions are. Right? Because if I lose 38% of it, that means I still get 62. Okay, so I've got a project to do a Schedule A together, or not together, but just kind of as a in-class little project. But let's first turn our attention to the tax returns and see what we've all got in front of us, because there's some kind of interesting things going on there. You are going to be working, let's pull up a 2106, let's start there and all look at that together. So there's one on page, I'm not seeing a 2106.
Here's a 3106 easy on 5-25.
Do we want it easier or do we want it easier?
Well, I think you're going to have to do one of each. Yeah, let's start on page 5-25 for an easy. So this, it tells us at the top of it, you can only use this if you're an employee and you're deducting ordinary and necessary expenses. Bullet point number 2, you do not get reimbursed by your employer. And bullet point number 3, if you are claiming vehicle expenses, you're using the standard mileage rate. So essentially, if those 3 things are, your fact set, then you can use the 2106EZ. In our problems, one of the gals gets reimbursed by her employer. So she can't use the EZ. She's got to use the full 2106. But let's start with the easy. So the first item is complete part 2, multiply line by 56 cents. So this is the vehicle expenses. This is how many miles you drove your vehicle. And so whatever you drove, you multiply it by 0.56, and that number shows up right here. Number 2, parking fees, tolls, and transportation, but this is not overnight travel or commuting to and from work. Is commuting to and from work ever deductible? No. What's the difference between transportation and travel? Exactly. Travel is away from your tax home overnight. Transportation is in the local area. So if you have to, my son goes all over San Francisco to different jobs, so he's always crossing the bridges, and the tolls are like $8 a pop. He saves those receipts. That's all deductible, isn't it? That's transportation. But if he travels to do a recruiting job, that's travel.
I'm just asking, I don't know what, we used to do the same thing, they get easy pass thing.
Yeah, but then they give it to you, so it's not an expense to you, is it? So you don't have anything to deduct. Number 3, travel expense while away from home overnight. This is the lodging, your car rental, your airplane. Do not include meals and entertainment. How come they don't want that number in there? You only get 50%. That's down on line 5. So do not put your M&E up in line 3. And then line 4, business expenses, that's not included anywhere else. What kinds of expenses are not included anywhere else? Maybe stuff like business expenses, yeah, uniforms, dues and subscriptions.
Would that go there?
You're not going to get your fuel if you're taking 56 cents a mile. So 2106 is pretty straightforward. What if your employer reimburses you? Then what do you have to use? You have to use a full 2106. So let's just take a quick peek at that. And there's instructions, you guys, for a 2106, which will probably be helpful for you doing one of the cases. So an actual 2106 is a little bit more complicated, and you can see that basically part one is your expenses, and then part two is the reimbursements. And it's the same categories: vehicle expense, parking fees, tolls and transport, travel expense, other business expenses. M&E goes over here in column B because that's only 50%.
Did you put the full amount in there and then multiply by 50% and do the total on the next line?
Okay, that's a good question. So Jess is asking what number goes on line 5. Is that the whole M&E or 50%? That's going to be times the 50%. But in the software, I think you put in the full amount and they do the math for you. Okay. Oh, and then the other point I should make is that when you get your 2106 or your 2106 EZ done, that number travels straight to schedule what? A. It goes straight to schedule A on that line, whatever that is, 21 or something. And then your software will subtract 2% of AGI. Go ahead.
On the 8 or 20CCD, it says complete part 2 from line 8. Where's that line 8?
Oh.
The very first line, it says multiply line.
Oh, no, that's part 2 down on the bottom of it, your vehicle expenses. Now, let me say one more thing, and I hope you can process this. If not, please clarify. When we get to Montana and you're married, what do you do with itemized deductions for a married couple? Yeah. Tirsa's back here going like this. You actually came up with the word. Yes, you want to equalize it. You're pushing your itemized deductions wherever you can to get the TI equal. So basically, you're going to give the itemized deductions to which person? High or low income? High. Except for what kinds of expenses?
Stuff that phases out.
Okay, I can't really think of an example of it.
Where it's based on your, like, 10% of your income.
Okay, oh, that's what you were saying. Yeah, your medical. You're not going to give your medical expenses to your high income person, are you? Because 10% of AGI, it's going to cut them all out. So you're going to push those over to the what? Low income person. Except for in Montana, what happens with health insurance premiums? Is that in the big number that gets cut by 10%, or does that stand on its own? That stands on its own, so that goes to the high income person. And lastly, you can't play with these. In other words, I can't give my employee business expenses to my husband. They have to stay with me. So if I'm really high income, they're probably just going to go away at the 2%. But I can't push them over to him if he's lower income. Okay?
Which makes more money.
It does, damn it. Okay. So with that, the 3 cases we're doing, I don't even know if I brought my packet. I don't think I did. Oh, thanks, Phil. Our cases, 11, and I wrote up here, you must do cases 11 and 12, and if you want to do 13, you may receive up to 10 points of extra credit. I'm going to just say one thing about case 11. Watch the 125 very carefully. Case 11. Anderson works for Gregson Cattle Ranch, and he earns his wages were $45,000. He's also got a 125, and he puts $200 a month into the flex plan. And my question is, how does this information affect what you enter in the W-2 screen? Don't say it out loud, but you better think about that.
Oh, I thought you were going to tell us.
No, I'm not going to tell you.
Oh, you trigger. All right.
So first off, I will tell you though it affects his W-2. The second thing about case 11 that you need to be aware of is that he uses pre-tax dollars to pay for some of his medical expenses. And I tell you about that. He fully utilizes the pre-tax amounts out of his flex plan in the current year, as you can see by his medical expenses below. He's done braces and glasses and had a surgery and he's had a lot of stuff. So he's taking out the entire amount that he put into his flex plan to put towards all of his medical bills. Case 12 is just what I was saying, you're going to have to play with the deductions on Montana.
Any info on case 13?
I gave you a check figure for the 2106 for case 12 because it's a bear. That's in that little box over there on the right. Hint, the 2106 check figure is $12.50. On case 13, we'll talk about that on Tuesday. I'm going to leave you with 11 and 12 right now. So what I think you should do right now is start on your manual recap for 11. And then hopefully you'll even get to the point of the software today. The plan is an hour today in class and about an hour and a half in class on Tuesday. Thursday, no.
Next week,
Oh, today's only Tuesday.
Unfortunately, it is.
Beautiful. Okay. So I was like, holy buckets, I didn't give them much time on these. So you have an hour and a half on Thursday on this, and then an hour next Tuesday. So that's 2.5, 3.5 hours of in-class time. These are due November 5th at 10 a.m.
What day is it, November?
Thursday. So in other words, I want them stacked up at the beginning of class on Thursday, November 5th.
chapter 13 also.
Yes, ma'am. 11, 12, and 13 if you want to do it. Homework for chapter 5 is for Thursday. This Thursday. Okay.